Welcome back to World Financial Secrets. Before we talk about inflation, before we talk about debt, before we talk about why Bitcoin, gold, and hard assets keep pulling people in, I want to hit you with a quote that should make you pause. Not because it's poetic, but because it's brutally honest. Henry Ford once said, "It is well enough that the people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning." That is not a random quote. It's a compressed truth. The system works best when you don't understand it. And that's exactly why this video may feel unsettling compared to what you normally watch. I've spent the last 4 years exploring the financial world. Not just markets, not just investing, not just headlines, but the underlying plumbing, how money is created, who controls it, and why the rules feel invisible. And the more you look, the more you realize something disturbing. Most people aren't bad with money. Most people are trapped inside a structure they were never taught to see. This video is not meant to scare you. It's meant to give you a clearer map of reality, because if you understand this, the world suddenly makes more sense. And yes, if you want to understand why Bitcoin and other cryptocurrencies may keep rising, this is foundational. So take a breath, and let's begin with the most basic question of all. Layer 1. Who controls the money? Who controls all of our money? It sounds almost childish, but it's the most adult question you can ask. You don't control it. Your boss does. So who do and where does money even come from? Here's money does not come from the government. Most people assume it does because government prints cash, mints coins, and puts faces on bills. But that's the surface layer. The deeper layer is, who has the authority to create money at scale and inject it into the economy? And here's why this matters. Most people spend their entire lives orbiting money. We go to school, then university, then work. We trade time, hours of our lives, for a paycheck. Money becomes the language of survival, the source of anxiety, the tool for freedom, the reason families fight, the reason people stay in jobs they hate. So how is it possible that the most important mechanism in modern life is also the least understood? Because it's rarely taught, rarely questioned, and almost never explained in a way that exposes the structure. This video will. Layer 2, 1694. The blueprint is born. Let's go back. 1694, England. England has been bleeding through decades of war. The state is exhausted, financially cornered, and desperate for loans, so the government needs money. Now. And here enters a Scottish banker named William Patterson with a solution that changes history. Instead of the government borrowing from scattered lenders, create a privately owned bank that can issue money and lend it to the government. Think about that. A private institution becomes the gatekeeper between the nation and its own money supply. That bank becomes the Bank of England, the first modern central bank model. And from this moment, you can see the blueprint. Government needs funds. Central bank creates money into existence. Government borrows it with interest. The public pays the long-term cost. Central banking becomes more influential than elections and laws, yet remains strangely invisible to the general public. Layer 3, 1910. Jekyll Island and the US version. Fast forward to early 20th century America. 2 earlier attempts to bring central banking to the US had failed. The public didn't want it, so the strategy changed. Do it quietly. December 1910. Senator Nelson Aldrich boards a private train in New York with 6 other men. No press, no questions, no public debate. They travel to Jekyll Island, Georgia, a private club, a controlled environment. The meeting lasts 9 days. And out of that meeting comes the design of what becomes the Federal Reserve System. This is documented. Public record, not rumor. Some of the men involved later admitted the secrecy was intentional. Frank Vanderlip wrote in 1935, "I was as secretive, and indeed as furtive, and as any conspirator. If it were exposed that our group had written a banking bill, it would have no chance of passage by Congress." That sentence is everything. It tells you the plan wasn't to educate the public. The plan was to pass something the public would reject, if they understood it. And here's a detail that reveals scale. Those 6 men represented immense concentrated wealth. In 1910, they represented a quarter of the world's worth. When a small group with that level of wealth designs the financial architecture, you should at least ask, who does it serve? Layer 4. The Trojan horse. Strategy now comes the deception layer on textbook. The Fed was originally drafted as the Aldrich Bill, but Congress recognized the name. It smelled like a setup. So the bankers needed cover. They renamed it, repackaged it, moved the bill through friendlier channels. Then they ran a psychological operation in public. They loudly protested the bill in newspapers. They screamed, "This will ruin the banks." And what did the average person think? If bankers hate it, it must be good. So people unknowingly supported a Trojan horse. Even Congress got played. Clauses were inserted to limit power, then later removed after passage. A double-head fake. The public was misled, and the lawmakers were outmaneuvered. And then the timing. December 23, 1913. When the bill passed, and with that, a small group gained monopoly power over the creation and issuance of American money. Layer 5. Independent means untouchable. Today, the Federal Reserve is arguably the most powerful entity in the U.S. financial system, and they openly describe themselves as independent. Alan Greenspan said, "The Federal Reserve is an independent agency. There's no other agency of government which can overrule actions that we take." That's not a minor detail, because independence here isn't just freedom from political pressure. It's something deeper. The money system can be steered without direct democratic control. Interest rates, liquidity, credit conditions, the financial climate of an entire nation can be shifted. And if you're thinking, well, surely someone audits and monitors everything, watch what happens when questioning turns to oversight. A congresswoman asks about a massive amount of emergency credit, trillions, and the response suggests something chilling. The lines of accountability become foggy. Even the inspector general appears unsure who is keeping track. That uncertainty is itself a form of power. Layer 6. Why this affects you even if you're not American. At this point, you might be asking, so what does this have to do with me? I don't even live in the United States. 2 reasons. Reason number 1, the central banking model has been copied worldwide, and in Europe, power is consolidated under the European Central Bank, uniting multiple nations under a single monetary policy. Only a few places lack central banks. Reason number 2, the big one, since World War II, the US dollar became the world's reserve currency. That means central banks around the world hold US Layer 7, 1971. The gold standard ends, trust begins. Under the post-World War II monetary system called Bretton Woods, US dollars were backed by gold and exchangeable for it. A byproduct, currencies were more stable relative to each other. Exchange rates were fixed and predictable. It was easier to plan long-term business. Then in 1971, amid pressure on the dollar, capital flows into gold, and the cost of war, President Nixon suspended convertibility of the dollar into gold. From that moment on, the dollar floated, backed by nothing tangible. And it has been ever since. So think this through carefully. If the world holds reserves in dollars, and the dollar is backed by nothing, then all currencies tied to that reserve system are ultimately backed by trust. This is fiat currency. Fiat essentially means it is money because authority says it is. And the consequence of this isn't just philosophical, it's mechanical. When the Federal Reserve creates money, it expands the supply. That expansion dilutes purchasing power, directly or indirectly, for everyone tied to the system. And in recent years, massive money creation has triggered reactions. Countries like Russia and China have sold reserves and bought gold over time. Layer 8, the mechanism, how money is created out of nothing. Now we arrive at the part most people never see. A central bank manages money supply and can loan money to governments with interest. In the US model, government needs more money than taxes provide. Treasury issues an IOU, a bond. That IOU passes through banks to the Federal Reserve. The Fed effectively writes a check for that IOU. But here's the question. Where does the Fed get the money to write the check? They create it. Boston Federal Reserve said, "When you or I write a check, there must be sufficient funds." But when the Federal Reserve writes a check, there is no deposit. When the Fed writes a check, it is creating money. So it's money created from an account with no money in it. If you and I did that, it would be fraud. But they can do it because the system is built that way. And it doesn't stop at central banks. Commercial banks also create money when they issue loans. Graham Towers said, "Each and every time a bank makes a loan, new credit is created. Brand new money." Paul Tucker said banks extend credit by increasing the borrower's account. Meaning, banks don't simply lend out deposits. They create new money digitally. And today, 97% of money is digital. Only 3% is cash and coins. Then there's fractional reserve lending. Banks can lend multiples of their reserves. Layer 9. The consequence. Inflation is the hidden tax. So what's the issue? Why should you care? Because when more loans are issued, more money is created. And when money supply expands, existing money buys less over time. That's inflation. And here's the uncomfortable framing. Inflation functions like a silent tax. It's the cost society pays for money creation. It's also why a house that cost $7,000 in 1950 is not remotely priced the same today. And for a long time, wage growth tracked inflation enough to keep the illusion stable. But around 2008, something changed, and wages stopped keeping up for many people. That's a separate story, but the point remains. As long as the system continues, prices have upward pressure over time. Climax, the hidden secret people don't expect. Now here comes the twist, the thing most people never expect. When money is created this way, it doesn't just create money. It creates debt. Debt becomes the backbone of the economy. Mariner Eccles stated, "If there are no debts in our money system, there wouldn't be any money." So under this structure, debt is not just a problem. Debt is the fuel. This is why it's called a debt-based monetary system. It requires debt to keep growing, because debt creation expands the money supply. If people stop borrowing, money supply contracts, and the system begins to seize up. That's why the system constantly nudges borrowing, credit expansion, and stimulus. And once you see that, you understand why the normal state of modern economies feels like permanent debt, periodic bubbles, sudden crashes, and concentrated wealth accumulation at the top. Layer 10. Booms and busts. The levers of control. The Fed and central banks control money by managing the supply of money and the cost to borrow it, interest rates. With these levers, plus human psychology, booms and busts emerge. Case study. In 2000, Alan Greenspan cut interest rates to 1% to fight recession and encourage borrowing. Cheap borrowing made mortgages cheaper. People bought houses, prices rose. People felt wealthier. They spent more. It stimulated the economy. But people borrowed too much. The bubble inflated. And then came 2008. Yes, bankers played a role. But the central bank's policy lever had enormous long-term impact. And then you see Japan. The central bank buying so many stocks it became a top buyer, owning parts of companies with money created from nothing. Layer 11. What leaders warned about. When people actually understood central banking, warnings were blunt. Whoever controls the volume of money is absolute master. Benjamin Franklin argued, money control was central to the American War of Independence. Milton Friedman said the Fed caused the Great Depression by contracting the money supply sharply from 1929 to 1933. So yes, some argue central banks aren't inherently evil. They argue the problem is private control, misaligned incentives, lack of democratic accountability. Lincoln believed government should issue currency directly for public benefit. He issued the greenback. No further comments on that story. Ending, the message that sticks. So I'll end the video here because if you truly absorb what you've just heard, you start to see history differently. Wars, revolutions, collapses, when you dig deep enough, so often lead back to money. But there's something happening now. A growing number of people are rejecting the debt-based system. They're moving into gold, silver, and cryptocurrencies like Bitcoin. There may be light at the end of the tunnel, but it starts with awareness. If you watch this entire video, congratulations. You now understand the hidden truth behind one of the most guarded mechanisms on Earth: who controls money and how it's created. And if this is your first time hearing all of this, do your own research. Because once you do, you'll start seeing the bigger picture everywhere. For starting points, you can look into Mike Maloney's Hidden Secrets of Money series and books like The Creature from Jekyll Island by G. Edward Griffin. This is World Financial Secrets. If this video expanded your mind even a little, subscribe, because what you just saw is the foundation, and the next videos go even deeper. See you soon.